Tiny fees look harmless, but over decades they quietly siphon years of progress from your compounding, which is why the most reliable performance upgrade is cutting costs you already control in US accounts. Today's goal is simple. Keep your same index exposures while shrinking the fee leak by understanding expense ratios, tracking difference and tracking error, and trading frictions that add up in the background. Start with the fee you see on every fact sheet. The expense ratio, which is skimmed daily from fund assets and silently reduces reported returns every single period. Even single-digit basis point differences compound into meaningful gaps over long horizons, so for core exposures, always compare same-we index options and prefer the lowest cost, no-load share classes available in your plan or brokerage. Remember that an index has no fees, so any ongoing cost inside a fund must show up as a shortfall versus the benchmark unless other mechanics offset it. Next, separate tracking difference from tracking error so you can judge implementation, not just labels. Tracking difference is the average performance gap versus the index over time, which typically reflects fees, trading costs, and structural frictions like dividend timing and taxes. Tracking error is the volatility of that gap, how tightly a fund hugs its benchmark month by month, which matters if you want predictable index-like behavior. Causes include fees, cash drag, sampling rather than full replication, reconstitution timing, dividend reinvestment lags, foreign withholding taxes, liquidity of the underlying holdings, and market volatility. Good implementations minimize both the average shortfall and the variability around it, which you'll see in a small negative tracking difference and low tracking error versus the stated benchmark. Exchange-rated funds add a visible trading layer, bid-ask spreads, occasional premiums or discounts to net asset value, and the quality of your order placement. Spreads are a variable toll paid when you cross from the bid to the ask, and they widen when the underlying market is less liquid or during stressed moments, which is why simple practices like using limit orders and avoiding the first and last minutes of the session help. ETFs can trade a bit above or below their underlying value due to supply and demand and the cost of moving the basket, so a patient limit order near the midpoint reduces slippage on larger tickets. Many U.S. brokers charge zero commissions now, but that doesn't make spreads or execution timing irrelevant, especially in lower liquidity funds or in choppy markets. Mutual funds come with their own list of frictions to check before you buy, starting with legacy share classes that embed loads or 12b1 distribution fees you can generally avoid by picking no-load, low expense share classes. High turnover and cash redemptions in active mutual funds can also trigger capital gains distributions in taxable accounts, which adds a tax drag even if you didn't sell, making low turnover index funds a better default for core holdings. When you do need to trade mutual funds, end of day NAV execution removes intraday timing choices, which can be a behavioral plus but doesn't change the importance of the ongoing expense ratio. ROF. Some costs hide in the plumbing of replication, so look past headline fees. Index funds and ETFs can suffer cash drag when they hold distributions or contributions uninvested briefly, and they can incur slippage around index reconstitutions and corporate actions if they must trade when everyone else trades. Funds that use sampling rather than full replication may see larger deviations if the chosen subset doesn't mirror the index's factor and liquidity profile, especially in small-cap, international, or bond universes. Foreign indexes introduce withholding taxes on dividends and additional frictions that can increase tracking difference, which is another reason to compare realized gaps, not just stated ERs across similar products. Scale and structure matter for costs you don't see. Larger, seasoned funds often benefit from tighter secondary market spreads and more efficient primary market creation divided by redemption, while very small, niche funds can face wide spreads and higher closure risk that complicate long-term holding. Securities lending can partially offset fees when a fund shares lending revenue with shareholders under a conservative collateral policy, which shows up as a smaller tracking shortfall than the ER alone would suggest. To turn all of this into action, estimate your total cost of ownership for each core sleeve you hold or are considering. Add the expense ratio, A realistic spread cost per trade multiplied by how often you actually trade, any platform or advisory fees, and the realized tracking difference to capture real-world implementation. Then compare likey for you like across funds tracking the same index. For ETFs, weigh median spreads and on-screen liquidity alongside fees. For mutual funds, focus on share class cleanliness and documented turnover. When two funds track the same benchmark, pick the one with consistently tighter tracking difference and lower total friction, not just the one with the tiniest printed ER. Execution is the last place fees can creep in, and simple habits keep them small. For ETFs, place limit orders near the midpoint. Avoid the open and close when spreads are wider, and stage large orders if markets are thin so you don't pay unnecessary impact. For mutual funds, submit before the cutoff and let NAV execution remove the temptation to time, accepting that the ongoing fee is what you can most effectively control. Your account lineup influences where each dollar of cost hurts most, so align placement with both fees and taxes. If you have room, shelter taxable bond income in tax-advantaged accounts, and park broad equity index funds or ETFs in taxable accounts where their lower turnover and potential tax efficiency can shine, while still choosing the lowest friction vehicles available. In employer plans, scan plan documents for plan-level admin fees, and pick the cleanest, lowest cost index options on the menu, even if the ticker differs from what you hold elsewhere. Make fee control a routine, not a one-off. Once a year, run a quick fee audit, confirm expense ratios haven't drifted higher, check that realized tracking differences remain tight, review median spreads on your ETFs, and review any platform or advisory fees against current market norms. If you uncover cheaper equivalent exposures tracking the same index, plan a tax-aware transition, swapping inside tax-advantaged accounts first, and using losses or long-term gains in taxable to minimize the bill. The fastest wins usually come from replacing expensive share classes or redundant funds with broad, low-cost index vehicles that have strong tracking records. Then lock in simple trading hygiene and place assets where fees and taxes do the least harm so your ongoing drag is structurally lower without changing your strategy. This is how your earlier choices, broad indexes, low-cost ETFs or funds, and a stable rebalancing routine translate into more of the index's return reaching your account after all frictions. If there's one rule to remember, it's this. The market's return is uncertain, but fees are guaranteed, so keep them low and predictable. Pick the cheapest clean implementation of your chosen index, verify tight tracking, trade thoughtfully, and repeat the fee audit annually so small leaks don't become permanent headwinds. The compounding you've planned for with DCA and rebalancing is too valuable to donate to avoidable basis points year after year. As a callback, this ties directly to your index and ETF choices and the rebalancing rules you've already set, because minimizing costs lets those rules deliver closer to index results in real life. Up next, shift from cutting drag to fueling growth by understanding how dividends contribute to total return, how reinvestment policies affect compounding, and how to set your accounts to capture and redeploy income without busy work.